Thank you everyone for making your way to the fifth panel at Money as a Democratic Medium this morning. We'll have 3 speakers and about 120 minutes, so we have plenty of time. There'll be about 20 minutes per presentation and then about 20 minutes of discussion. I'll introduce the speakers as they go up to the podium, so you don't have to remember everyone ex ante. And when it comes to questions, I'll keep an eye both on Zoom, and if you're watching this online, I would ask you to put your questions into the chat, and then I will bring them into the room. And if you have questions in the room, just raise your hands and I will keep a list. And on the list, I will look for gender balance. So if there are 4 guys and 1 woman, put your hand up, I'll bring the women in first and then balance it like that. With that in mind, Simon's going to start us off. Simon Hess from the University of Rostock, where he's a PhD candidate. Before Rostock, he was at Salzburg, Göttingen, Fulda, and he'll be presenting his paper, Regulating Central Bank Digital Currencies Towards a Conceptual Framework, which is the first paper of his PhD thesis, which is entitled The Legal and Economic Dimensions of Central Bank Digital Currency.
Yes, thank you for the introduction. I think I will present from there. This is working? Yes. Wonderful. Okay. And if you're more interested in my paper, then you can also find it under this link at SSRN, just for information. Okay, this is the agenda for today. I will start with the background. I go through the aims of my paper and through the limitations, the access options, the legal form of CBDC, existing examples of CBDC regulation. Then I will show the conceptual framework. I will do some evaluation of regulatory options, and I discuss those options, and I will give a conclusion. Okay, let's start with the background. We all know that the use of cash is in decline in some countries, especially in Sweden. This is the blue line, and it's decreasing every year. And at the same time, central banks losing relevance in daily payment transactions. And there are emerging private digital currencies which are threatening the monetary sovereignty of central banks. This is, for example, Facebook's Libra. And the central banks are a bit jealous at those private digital currencies. But central banks also have a solution prepared. I have a video for this. You will see it at the next slide. I will hope this works. And the central bank just says, "Oh, call an ambulance, but not for me." And then he pulls a gun out of his jacket. Okay, and the solution that is discussed by central banks is central bank digital currency, a short CBDC. And in the current system, the central bank issues cash, which can be accessed by the general public. And it issues digital reserves, which can only be accessed by banks. And the discussion of CBDCs is about should the central bank issue a digital form of money that can be accessed by the general public. And now I come to the aims of my paper. The legal aspects of CBDC have not been studied in depth, and the existing research is restricted to mostly one jurisdiction and one CBDC design. And many central banks are not sure if they have the legal authority to issue a CBDC. And therefore, my two research questions were, how can the issuance of CBDC and provision of access be regulated? And the second one, how it should be regulated. And the method I used was a legal classification and a comparative legal study. And the limitations, I also want to emphasize the limitations. I only focused on the retail CBDC, not wholesale CBDC, which is accessible by a broad public. And I focused only on reactively issued CBDC. This means that this is initiated by the user, and the user just exchanges its existing deposits into CBDC. And this would increase the CBDC amount, but would also decrease the deposit amount and reserves amount of banks. And this does not affect the whole money supply. In contrast, this proactively issued CBDC, this would increase the money supply. This is initiated by the central bank, and this can be done via helicopter, money drop, or asset purchase. And I will not focus on this method. Okay, now I come to the access options, because these options are important because the legal classification and the legal form of CBDC depend on the access option. And with access, I mean storage, transfer of CBDC, and checking of account balances. And there are three options, which I define in the following way. With direct access, I mean the user has a direct legal relationship with the central bank to access the CBDC. And indirect access is the user has no direct relationship with the central bank, but a legal relationship with the third party to access CBDC. And lastly, there's hybrid access, which means that the user has a legal relationship with the central bank and with the third party to access CBDC. And I also have to note that these options apply only to account-based CBDC, because with token-based CBDC, you don't need a third party which transfers it, because you transfer it on your own if you have a smart card, for example. Okay, let's take a deeper look at the access options. This is how direct access would look like. There is CBDC is a direct claim at the central bank. And the central bank handles payments and customer service. And there's a legal relationship between these two parties, which can be a central bank account contract, which is a double-sided relation, or it could also be a one-sided relation if the central bank is obligated to issue CBDC. Yes, this is a legal relationship. And indirect CBDC can be provided in two ways. The first one is via intermediaries. The intermediary issues asset, which is called here iCBDC, and this is backed to 100% with CBDC. And the user can only access this iCBDC. And there are two legal relationships involved to access CBDC. The first is the relationship between user and the intermediary. which can be also account contract, and relationship between an intermediary and the central bank, which can also be a central bank account contract. And then there is indirect access via custodians. I think this was described for the first time by Joseph Hooper in his 1990s book. And there a custodian holds the CBDC in custody, and CBDC is still a direct claim at the central bank. And there is a custodian contract between user and custodian, and a central bank account contract between the custodian and the central bank. And lastly, there are two more ways of providing hybrid access. The first one is via payment service providers. They are the payment service provider initiates the payments, and the central bank executes the payments. And then there are three legal relationships. There's again the central bank account contract, there's a payment service contract, and the PSP needs also API access to access the central bank accounts. And the hybrid access via technical service providers is a bit different. They are the technical service provider, stores and transfers CBDC on the technical level, but the central bank is still the legal executor of the payments. And then there are again three relationships. Again, the central bank contract and contract on storage and transfer of CBDC between the user and the TSP. And the central bank also needs permission to issue and withdraw CBDC to or from the database of the TSP. Okay. And now I go through the legal forms of CBDC. We've learned that CBDC can be a direct claim or indirect claim at the central bank. And these are the existing legal forms of money. We have on the top, central bank money. This is issued by the central bank, of course. And we have bank deposits, which are issued by commercial banks. And they are backed by central bank money to a small degree. And then there's e-money, which can be issued by non-banks, but also by commercial banks. And also the central bank, for example, in the EU can also issue e-money. And e-money is usually backed by commercial bank money. And in some countries, it also can be backed by central bank money. And then there are money mutual fund shares, and they are backed by money market instruments, and they're issued by money market mutual funds. And then there are virtual currencies and in the form of vouchers, and virtual currencies in the form of cryptocurrencies. Okay, and CBDC, according to a definition by Meaning et al., is any electronic fiat liability of a central bank that can be used to settle payments or as a store of value. So if you look at this table, then I would argue that central bank money in the form of deposits and cash and e-money could be used to issue CBDC as a direct claim. And bank deposits, e-money, and MMF shares can be used to issue CBDC as an indirect claim and issue CBDC-backed assets. Okay, this is a more detailed classification scheme. If the access option of CBDC is direct, then the legal form depends on legislation. It can be central bank deposit if it's issued under the deposit section of the central bank law. It can be central bank e-money if it's issued under the e-money law. And it also could be cash if it's issued under the central bank law, and more particular the cash section. And if it's indirectly provided, then we have to ask who's the third party. If it's an intermediary, then it depends on the type of liability. If it's equity, then it's most likely a fully backed MMF share. And if it's borrowing, it also depends on the legislation. And it can be a fully backed e-money or a fully backed deposit. And if CBDC is provided via custodians, it's the same legal form as with direct or hybrid CBDC. but it's also held in custody. Okay, now I'll provide you some examples of CBDC regulation. In Germany, the German insurance company Talanx requested a deposit account at the Bundesbank in 2009. This was directly after the financial crisis of 2008. And this was this is how it looks. And the Talanx company would have a central bank account contract with the Bundesbank, but the Bundesbank said no, rejected the request, and Talanx began a lawsuit, and the court decided in favor of the Bundesbank, since accepting deposits is at the discretion of the central bank. And there's also an example from the USA with iCBDC, it's indirect CBDC, because the American bank, the Narrow Bank, they requested a deposit account at the Fed to offer fully backed deposits. This would look like this. But the Fed did not respond for 18 months. And the Narrow Bank filed a lawsuit because of the long processing time. But the judge dismissed the lawsuit since the short processing time is not guaranteed. I think the judge said that only if it exceeds 30 years, then it would be illegal. And today the Narrow Bank is still waiting for the response. And there is an example of direct CBDC in Ecuador. In Ecuador, the central bank issued e-money between 2014 and 18. And thereby the citizens had a right to participate in the e-money system. But the system was discontinued due to little popularity among the population. And there is one interesting example of CBDC in El Salvador, because El Salvador enacted its e-money law in 2015. And this law requires e-money providers to fully back the e-money with central bank money. And the law obligates electronic money providers to issue e-money for citizens and made a contract with them. And in 2016, there were about 1 million users, which is quite high when you have this population of 6 million. And this is my final conceptual framework. So what I found out is that the issuance of CBDC and provision of access can be provided in 3 ways. I call this the level of obligation. The first one is the issuance of provision of access is discretionary for the central bank and the involved third party. This is the case, for example, in Germany, what I have already shown. And the issuance can be discretionary for the third party. This would be the case in the US if the Narrow Bank gets this account. And the issuance could be mandatory for the central bank and the third party. This was the case in Ecuador and it's also the case in El Salvador. And I also want to evaluate these options. And first, the legal form of CBDC. This depends on the final design of the CBDC and access option. For example, interest-bearing CBDC cannot be issued as e-money because e-money doesn't bear any interest. And the levels of obligation highly depends on the perspectives of the involved parties. The consumer may prefer a right to CBDC since it provides non-discriminatory universal access to central bank money like cash. And the central bank, of course, may prefer a CBDC at their discretion to preserve full control over the money supply. And third parties may prefer a CBDC at their discretion to provide them contractual freedom. And I also evaluated the access options, and I came to the conclusion that this hybrid access through payment service providers and technical service providers would be a good trade-off because it offers competition and minimal operational duties for the central bank, but it's not that unnecessarily complex like intermediary CBDC or custodian CBDC, because in both cases you have this multiple layers of assets, which yeah, it's not necessary. Okay, I want to discuss my results. My results may have implications for research because this framework provides the foundation for the legal assessment of CBDC, and the levels of obligation can be considered as an additional design option. And my implications for practice is that the framework can be useful for central banks to assess their legal authority for issuing CBDC. And implications for policy: my research shows policymakers' regulatory options and trade-offs for these options. And finally, come to the conclusion. The regulation of CBDC encompasses two components. The first is the legal form of CBDC, and the second is the level of obligation. And CBDC is only cash-like if citizens have the right to CBDC, I would say. And hybrid CBDC may be a promising trade-off among all access options. And then there are also opportunities for future research, for example, CBDC and privacy, and another topic would be CBDC and legal tender. And this was my presentation. Thank you for your attention.
Nico, in the technique, just one question. So I'm still on mute here on the Zoom, but is there another Zoom way that gets the sound to the people? Sorry? Ah, okay.
You're not audible through that meeting.
Got it.
Speaker meeting.
Got it.
That is supposed to be used.
Excellent. Okay. All right. Questions? I see the gentleman over there, and then Michael afterwards. And I think if you come up to the microphone to ask the questions, then the people in Zoom will.
Hey, thanks. Can you maybe show the slide with the balance sheets again, please?
Try now.
Yeah, so
this one, or
yeah, exactly. Yeah, so I'm a bit confused. Well, first of all, I think what you call indirect access here on the left-hand side in the middle, I mean, this is what I would call hybrid, because we have this iCBDC in the middle in the commercial bank. Yeah, so I would call it hybrid, but that's maybe kind of semantic issue. What I don't really get is these two things to the right, where you had payment service provider and technical service provider. Isn't that just a special case of the third thing on the left-hand side?
And no, because with this custodian CBDC, CBDC is held in custody, and then there are only two legal relationships involved in providing CBDC. And with hybrid, there are always three legal relationships. And CBDC is a direct claim which is not held in custody, but you can combine them both.
Okay, thank you.
Yeah, just a super quick, and I think I'm loud enough.
On Zoom.
No.
I'm sorry.
Just a very quick thing for Ecuador, you might want to add one bullet. It wasn't just that it was unpopular with the population, it's also that the banks lobbied against it in a major way, and that may have contributed to that. I talked to the Ecuadorian central bank back in the day, and that was a big issue at that time.
Yeah, what I also read is that the government didn't back it enough. For example, it wasn't possible to receive payments as a public servant. Also, if you want to, but it wasn't possible, and this also led to that it was discontinued.
Yeah, many thanks. I'm wondering whether so Leon Mansleben, Max Planck Institute. So I'm wondering whether you also think about the politics of this, and particularly the politics of banking and the interests of the banking sector. Just one thought on that. If in the current scenario, you would have the model of the narrow bank, right? The example you gave from the US, the entire revenue of the narrow bank would depend on the Fed paying interest on reserves, right? And so the business model of the bank would essentially rely on the fact that deposits that people leave with this bank with a lower interest rate than the interest rate that they get from the Fed, right? And that difference would essentially be their revenue. So they would be entirely dependent on the central bank for their revenue.
Not necessarily, because the users can also pay fees to finance the business model.
Okay, another version of interest rates, but essentially the users would be able to decide whether they want to deposit their money there or somewhere else, and so that would create pressure essentially to pay interest, right? That would be the real pressure. That's what we've seen with Silicon Valley Bank, essentially, right? That there's, and I was wondering whether you could say something also about this with regards to the other models, whether you have some thoughts on that, because it seems to me that maybe China is a special case, but in other contexts, particularly Europe, the question of how to secure the business model of commercial banks in this scenario seemed to be a major factor.
Yeah, I would suggest that usual commercial banks act as payment service providers and then only initiate payments based on the central bank accounts. And in Europe, we have today one big payment service provider, which with the name Klarna is a Swedish one, and this company performs millions of those payment initiation services. And I think it would also work with CBDC, because they also do not receive any interest payments. They're just living from these fees that they raise.
It doesn't solve the problem, because that's just the transactions. The question is where you keep your money. Klarna doesn't hold the accounts of millions of euros.
Do you mean the operation costs of these accounts, of the database, or?
Maybe we'll keep that discussion for a coffee break and take one.
Okay.
Following Leon's good example, if you could briefly introduce yourself.
Yes, absolutely. My name is Jörg Schmerz. I'm from the University of Gothenburg in Sweden. That is really cash. So my question was whether I understood it correctly that you claim that a right to direct access to CBDC lowers the central bank's control of money mass. Did I get it correctly? And if so, why? Because it seems that if ever a customer requests to get central bank digital currency, the bank will sort of provide reserves to the central bank, which sort of seems to equal out the effect on money mass. Thank you.
Yeah, but it will increase the central bank money supply. It does not increase the whole money supply, consists of deposits and central bank deposits, but it will increase only the central bank money supply. Maybe for monetary policy operations. I can imagine, but I'm not an economist.
We've got a question on Zoom, which runs, do you know something about the progress of the digital euro development at the ECB? That's from Ari Sneo. Sorry for probably butchering your name.
Yeah, I think the EU Commission wants to propose wants to make a law proposal. I think this week or next week, and it also was leaked to the German Handelsblatt. And I think that the important thing is that the ECB needs a new law to issue the digital euro, because under the current law, it's a little bit tricky, because by default, the ECB cannot issue deposits to the general public, but only through a new monetary instrument if the majority of the ECB's council agrees with that. So it, basically, the ECB waiting for a new law to introduce it.
Ari continued with his question, asking whether they are planning a digital wallet model where the amount of digital cash that a person can hold is very limited. Is that accurate? Is that the direction in which they're going?
Yes, I think so. I think the limit is at 3,000 euros.
Okay, then we'll take one last question from the back and then move on to the next presentation afterwards.
Thanks. I'm Gregor. I'm also a legal scholar. And I know it's a bit unfair, but I don't know. I don't see the problem here. And isn't it a solution in search for a problem? I don't know. I think online payment, they work. And I don't know. Do you need another store of value, or is it just a payment issue?
Yeah, I think that it depends on the perspective. The central banks, they claim we need this tool in the digital age to bring central bank money to the digital age. But this, I think, questionable, because the limits are set so low at 3,000 euro in the Eurozone. But if you look at the economic effects of a CBDC, then you might identify some advantages of it. Because I think it, for example, it can prevent the effect of sticky deposits, which means that banks only slowly adjusting their interest rates, and customers lose money that way. And it maybe under some circumstances can only CBDC can also increase financial stability, because it's a safe asset, which secure funds above the deposits which fall under the into the deposit insurance system. So I see this two potential advantages.
I'm afraid we have to move on to the next presentation. So, but I'm sure you can talk about this later. Okay. Okay, so next we'll have Professor Josef Huber from the University of Halle-Wittenberg, where he's Emeritus Professor for Economic Sociology. And he will be presenting his paper, The Monetary Turning Point from Bank Money to CBDC, which integrates the potential rise of central bank digital currency into a longer historical narrative of changes in the dominant type of money.
Yeah. Thanks for the introduction, and hello, everyone. My presentation on the monetary turning point comes in two parts. And the first is on a brief look into the history of money on modern times, or say the recomposition of the money supply in modern times. And then the second part will be about the competition baseline, that is the interactive dynamics between the various types of money or money issuers involved. I do it that way around. So what you see here is are three recompositions of the money supply having occurred during the last 300 to 400 years. And the first was the emergence of paper money, the spread of paper money in the second half of the 17th century. And the next one was the central bank note monopoly, or in the United States, the issuance of US Treasury bills, legal tender notes. And then from around 1900, we had the spread of bank money, bank deposit money, also known as sight deposits, demand deposits, or I don't know, there are quite a few terms for the same thing. It's about the bank account balances, bank money for short, which is by far the most important and the system dominant means of payment today. And we are now entering, or we are already, we are entering in the next such monetary turning point, which is the rise of CBDC. There is a saying by Mark Twain which goes, history doesn't repeat itself, but it often rhymes. And that nicely fits to our case, the succeeding recompositions of the money supply, because monetary turning points don't occur by chance, but they occur when certain conditions are given. And the first is that the incumbent type of money and the related money regime poses chronic problems. In our case, the bank money regime, which poses chronic problems. And at the same time, a new type of money emerges or is latent, offering some solution. And if you look here at the right side, as for the problems, the problem with coins was the natural scarcity of silver and gold. And that means that led to over centuries to a continued debasement of the coinage. And there was then so-called good money and bad money, and unreliable and difficult parities, exchange parities between the different coins. And that problem was overcome, a problem because that isn't conducive to market development. No. The problem was overcome by paper money, but very soon paper money came with a problem of its own, and the problem was there were very soon too many issues, and time and again printing too much paper. And so then over time again, there was the problem of reliability and validity of the private paper notes. And so a lack of universal acceptance of that means of payment. And that was overcome towards the middle of the 19th century by the introduction of the central bank note monopoly. In Europe, the central bank note monopoly over time was established in Europe, while in the United States, it was the US Treasury that had the monopoly on legal tender notes. And then around 1900 and the decades thereafter, we had the occurrence or the spread of bank money, because the central bank note monopoly, the problem was not the monopoly, but the problem was the gold standard. And also the American Treasury bills in most of the time were tied to a gold standard, not during the Civil War, but during the rest of the time. And the gold standard created an artificial scarcity of money. And then with the bank money, that problem was overcome again. But then over time again, we had new difficulties occurred. And that was excess dynamics of bank credit. And so since around 1880, 1890, we have become used to consider modern money as credit and debt money. And so that excess dynamics also created a permanent overshoot in the money supply. As soon as the gold standard was suspended or dropped at all. And so considering the problems of the current bank money regime, there is now a new type of money coming up, which will again change the composition of the money supply, and that's digital money in general. And digital money in general and central bank CBDC in particular. We just heard that it's not yet clear from today whether CBDC will have the form of central bank balances, so to say, central bank account for everyone, or whether it will have the form of a digital token. And I think that over time, maybe that for the beginning, you have some transitional forms. You may have digital wallet with an access to account-based money, but I don't think that's the future. I think the future are purely digital tokens and no longer book money, because the book money is what has created much of the problems we have today. And the important thing with digital tokens is they are held in a digital wallet and they are circulating directly payer to payee. There is no more monetary intermediation. Today, our payments are monetarily intermediated by interbank payment processes, but with having digital tokens, the digital tokens travels from one digital wallet to another, just like cash is circulating from hand to hand. There are no more monetary intermediaries. Of course, there is a technical infrastructure. There are interface providers or database operators or similar. To all what is known today, one can assume that a digital currency is superior to book money in various aspects, beginning with lower costs of provision and use for all parties, for the financial institutions, as well as for companies, private, public, households, and so on. There is improved use and improved ease of handling for everyone, suggesting the use of IT gadgets. There is an improved safety and in most cases the same or a faster speed of circulation, which is also important because it's tantamount to having more money in the overall economy. Importantly, and my understanding is the fact that digital tokens promise much improved implementation of monetary policy. And not least, digital tokens are programmable, which book money isn't, or only to a very little extent, but digital tokens are programmable, and that opens new horizons in managing payments and financial contracts, and that's also very important for the Internet of Things, for the machine-to-machine communication. Now let me come to the interactive dynamics. We are going to have the future of money is digital tokens, but what kind of digital tokens and issued by whom? And the first question is it public or private? Is it central bank or US Treasury issued or central bank issued? Or is it about private cryptocurrencies as we know them today? And if the latter, the question is, are these cryptocurrencies covered or are they uncovered? And if they are uncovered, that means that these types of money pretend to be base money in their own right, which is a proud thing, you know. And it's the type of we know as Bitcoin and Ether today. And if they are covered, then it's a kind of e-money, or it's a kind of different kind of money markets fund share also. And then it's called stable coin. You know? And so the arena of actors, then the relevant actors, in my analysis, first of all, CBDC is clearly in the pole position in comparison to uncovered cryptos and stable coins. Uncovered cryptos act as challenges to sovereign-based money, but that's more pro forma and much less so de facto. And stable coins are, if they do have a future, which I guess is quite possible, they are a new money surrogate, and they do not challenge central bank money or sovereign money. What they challenge is bank money. They are challenges to bank money. And well, then the incumbent is bank money, but it's on the defense. I will concentrate now on the relationship between CBDC and bank money, because current cryptocurrencies are not yet competitive enough as a general means of payment, as a means of payment in general use, because they are too slow, much too slow, too expensive, and also, or most importantly, they lack political support throughout, and for the foreseeable future, they lack broad-based acceptance in the public. They are, for now and for the foreseeable future, cryptocurrencies are special purpose instrument for very special user groups, and they are not relevant as a universal means of payment. Where are we here? Now, so far, most central banks have presented CBDC as if it were a marginal addition to bank money. So to say, in an arrangement of peaceful coexistence. And I think that's not realistic. The coexistence of CBDC and bank money will rather be one of competition and political rivalry. There is let's look at central banks. Banks and central banks are, of course, no monolithic structures, but there are various opinions and various attitudes. And also there is a quite naturally, so to say, a spectrum of progressives and conservatives within the central banks. And the progressives are the protagonists of CBDC who recognize the need for monetary changes, and in particular, among other things, also to restore adequate governability of the monetary system. And while the conservatives defend the status quo, and they want to retain the bank money regime, of which they are themselves an important part. Central banks are getting into a difficult role conflict here, because as bank of banks and lenders of last resort, they are ascribed the task of being the protectors and defenders of bank money. However, as initiators and issuers, suppliers of CBDC, they act as challengers of the dominant position of bank money. And so from the side of the banks, not surprisingly, there is a growing number of banking associations and bank-supportive think tanks and politicians who speak out against CBDC, as they are becoming aware that introducing CBDC over time and the spread of CBDC, that can easily be the historical beginning of the end of the bank money dominance. And judging by that defensive behavior alone, bank money is apparently on the defense. And bank money actually has always been second choice in competition with first choice sovereign coin or central bank notes, if the money using public had or has a choice. And that actually wasn't the case during the last 100 or 115 years, because technologically payment in cash is not competitive with cashless payment using bank book money. And secondly, central bank book money, the settlement reserves, the bank money on account, that has never been made available to the public. That was reserved to the interbank circulation. And so in that way, bank money was doubly shielded from having to compete with central bank money in the public circuit. And now, however, with the advent of CBDC, that is going to change. Wait a moment. So yeah, that's what you see. It's just a map. Some of you may know. It simply shows 110 central banks across the globe being in an earlier or later stage of developing CBDC, conceptualizing and piloting and so on. So as a matter of fact, CBDC is on its way. And we may expect a wave of launches, say, in the next 10 to 15 to 20 years. But don't expect a revolution overnight. That will not happen. But the two-tier split circuit system, so reserves and money in the public circuit, that is retained, and CBDC is issued via the banks only, and the availability of CBDC is going to be limited. For example, some central banks start with wholesale CBDC only, and not going to issue for now retail CBDC for everyone. And if retail CBDC, then transactions are going to be limited by amount. For example, the very huge pilot programs run in China, there the transactions are limited to digital yuans of 5,000 a day. That's about 740, 750 or so dollars. And also limited to 50,000 a year. In Sweden, I have read in the papers by the Swedish Riksbank, the Swedish e-krona is thought or planned to be restricted, like the use of solid cash is currently restricted in Sweden. And digital euros, the ECB says it plans to restrict the use of the digital euro to 1,000 euro per transaction and having 3,000 euros in store. Another proposal by a member of the board of the Federal Reserve is they want to rule out sovereign bond issuance payable in CBDC. Well, there are there are more restrictions in the pipeline, but to conclude, the thing now is that the central banks, apparently they do not yet have up their mind how exactly they want to design the CBDC they want to come up with. And that is again due, which would I want to point out in the end, it's the role conflict they are in between being supposed to be the guardians in control of their nation's currency and monetary sovereignty, and on the other hand, the actual present role as an auxiliary body of the banking sector, acting as protectors and defenders of the bank money. And the parastate status of bank money has been permitted to achieve. There is an English saying, you cannot have the cake and eat it. And a similar German saying goes, wash my back, but don't get me wet. And that's it. Central banks cannot introduce CBDC without repercussions on the bank money regime and their own role in that regime. And yet they must introduce CBDC at the current point in time, and then in this decade, the next decade, over next decade, in order to reassert their fundamental function as issuers of legal tender-based money in the public circuit, which is the real basis for having policy transmission clout and conducting effectual monetary policies. Thank you.
Thank you for the presentations. And since all the questions after the last one were asked by men, I would look especially for women asking questions and give that a second. The first question was by the gentleman over there. And again, if you could please come to the microphone, introduce yourself briefly, then catch my eye, and I'll put you on the list.
I'm Alexander Sinic from the Sustainable Finance Lab. Thank you for the presentation. I have two questions. So in the table where you indicate a timeline, you say that the reason for CBDCs is this loose access dynamics of bank money, etc. But in the previous regimes, I noticed that the state or the central bank stepping in is a kind of a result or a reaction towards these financial instabilities. But as you said, right now, the central banks and the ECB more specifically is is asking for a peaceful coexistence. So it does not want to infringe on the stability of, well, as they think about it, of the financial sector. So they're not being activists; they're being very on the back foot, so to speak. And then the second question, and yeah, my question is, why do you think that is? And then the second question is, you say CBDCs are coming in the 2020s or 2030s, but why not earlier? Why not 1980s or 1990s? I mean, we had banking crises and financial crises then. So why didn't central banks step in? I mean, and why not in 2008? So it was actually the civil society organizations that initiated the discussion after the 2008 crisis.
Yeah.
Thanks.
I didn't quite understand your first question. I'm sorry, but as far as I understand, it's about what's the reasons why central banks feel pressured or to develop and introduce CBDC. And beyond the reasons I mentioned, the main reasons are that the current system has chronic problems that cannot be overcome within the present system, because to put it in a way bluntly, a bit short, central banks have much lost, in my analysis, have much lost control over what's going on in the monetary system, because it's determined by what the private banking sector is doing. So the the proactive lead in money creation and in credit extension and so on, that is with the banking sector. And the central banks have not much choice but to react by accommodating to the facts the banks have created beforehand. So that's the general problem, and that applies all the more in times of crises, and the crises are recurrent because the private sector as such has no plan. So it simply follows its own business desires. It follows demand by the public, of course, by the money users, but also selectively its own business desires. And that has led, particularly during the last 40 years, to what is currently known as financializations, which is excess dynamics in non-GDP finance, in contrast to GDP contributing finance. And so we have a huge overhang of non-GDP finance with recurrent banking crises and threatening to lead to financial crises. And so the central banks are constrained, literally. They have no choice but to bail out the banks, and also the governments to warrant bank money. So, and in my opinion, from a constitutional point of view, that's actually a monstrosity. You know, that the state has to guarantee private bank money. So, and yeah, and then there are the new cryptocurrencies, and quite a few central bankers are publicly saying we need to have a digital dollar or pound or I don't know what, because we are going into a competition with these new cryptocurrencies. These are in a crisis right now, but they are here to stay in various ways. And that's another reason. And excuse me, what was the second question?
Why now? Why not in the 1980s or 1990s?
You mean why not earlier? Yeah, well, because particularly in Europe and in North America and in Japan, there are inside the central banks and inside politics, there is that they are caught in that role conflict between being today, so to say, the leading, they have an important, the central banks have an important auxiliary role for maintaining and retaining the bank money regime. And at the same time, they have to change something. And so the conservatives or the central banks are pursuing a rather bank protective approach to introducing CBDC, which means it will come not now but later, and it will not come as retail money, but first as a wholesale and so on. But at the same time, the Chinese say they are running pilots, but you know, these are pilots with 200 to 300 million users, and and accordingly much transactions already carried out. And the entire infrastructure for using the digital yuan is spreading very rapidly. And of course, also the Chinese public is reluctant in adopting the new thing, but that is spreading because the government is behind and the People's Bank of China is behind. They want to have to get that through. And so it's not only exchanged in certain banks that can and have to do that. It's not only exchanged against bank money, in exchange for bank money, but also the Chinese government has directly issued digital yuans in circulation as a kind of helicopter money carried out in a lottery. So the helicopter money came by lottery. You could participate in a lottery, and then if you were happy, you got a certain amount of digital yuans. And there are also in the Bahamas, we have CBDC, and yeah. So I guess that's why it will take time.
So we have 6 more questions, 4 in the room, 2 on Zoom. I propose we do 2, 2, 2. So first the gentleman at the back with the glasses, and then you, if you come to the microphone, then we do Zoom, and then Leon and you in front.
Very much. Can you hear me?
Yeah.
Yeah, my name is Kostas Lapavitsas. I teach in London. I appreciated your presentation very much. I've got a question to ask about how what you portrayed as a conflict between CBDC and bank money might unfold. It's this, from the perspective of the central bank, CBDC is a kind of fiat money.
Yeah.
Okay. But banknotes and bank reserves are also a kind of fiat. They're not convertible into anything. Current banknotes and current bank reserves. So from the perspective of the central bank, one type of liability is like another. It's a question of who holds it and what they do with it. So what if in this future you're outlining, the central bank allowed private banks to issue credit in indirect CBDC units? And what if they allowed them to have their own accounts of CBDC with the central bank, and therefore private banks would also use CBDC to pursue monetary and credit operations? What would happen then, and what would happen to the conflict that you're outlining?
Yeah.
Just before you answer, we'll take the second question as well, because otherwise we will not get.
Hi, Stefano from UCL. I also really much appreciate the presentation. Question is very quick. It seems like with having CBDC, we would take away some of the gun that is stuck to the country's head in terms of moral hazard from banks. But I question how much that's going to be the case, given that investment will still be part of the business of banks. So it's basically a question of how much the moral hazard and all the problems that we have with financial regulation is due to a too big to fail, or as you seem to be implying, that it has to do with the way in which we create money through banks. Thank you.
Mhm. It's me now?
Yes.
Okay. Well, wait a moment.
Context, we have about 5 minutes.
Yeah. The question, why would banks issue CBDC? No. As the name says, central bank digital tokens issued by the central bank, in the same way as central banks have circulated or are circulating solid cash for now. Now, the paper money, the central banks have the monopoly on paper money, and the government has still the monopoly on coins, but that's unimportant now. And it's both are fiat money circulated by the central bank. And CBDC is, well, it's central bank money, so it's a natural monopoly of the central banks. And the situation, banks will not be able to issue CBDC, or they might be able to issue digital tokens, but that would be bank money tokens. That would not be CBDC. And in any case, as you see on this list, there are really important money technical differences between deposit money and digital token money, because bank money is deposit money, and digital tokens are informational tokens of their own, like cash, formerly cash, but digital cash, so to say. That's not by chance another name for CBDC. And the deposit money is in the bank account and a balance sheet, and the other is in a digital wallet, and that is the bank liability. And digital tokens, very importantly, are just an asset of the owner only. It's not a bank liability. And as I said, digital tokens, there is a direct P2P payment from one e-wallet to another, like cash from hand to hand, and so on. That's it. And so that's why I don't think that the situation will be similar to, say, the time between 1850 and 1900, when in the overall circulation of money, cash was dominant. And at the time, central banks or the US government had the monopoly on cash. So then central banks then had to operate on a huge base of cash, and they were not able to simply to create their own bank money. That became possible by the spread of cashless payment. And in the course of that spread, the fractional reserve, the fractional base of bank money became ever less. And that's our problem today. That first, it's the fractional reserve that creates the problems. It's the fact that money today is credit and debt money, which exposes the monetary base of the financial system and the real economy. There is an exposure to financial risks. So money becomes part of the financial system, and if there are financial problems, the money is at stake. And that's the fundamental problem. And if you have a huge money base of fiat money, central bank money, or also government money, then that money is by its very nature safe and stable. And you can have bank crashes, so to say, and that will always occur. That's all the answer. My answer to the second question. Financial risks cannot be regulated away, and banking risks cannot be regulated away, and not with much private equity or whatsoever. Financial risks are here to stay, and they're quite natural. But the money should not be at risk. So the money. If the money, as is the case with bank money, if the money is, oh no, let me put it in another way. Our money, so to say, as bank money is held hostage to the bank's balance sheet. That's the problem. If there is a financial problem, our money is at stake. And that's a fundamental construction fault, a flaw. It's a flawed construction. But if you have safe and stable fiat money as the general money base, then we certainly will have financial crisis, but that money is not threatened to disappear in the crisis. That money continues to exist.
So the two questions from Zoom actually connect to that very nicely, and then I'm afraid the two questions from the room outstanding, we'll have to take them to the break. So the two Zoom questions are, the first one is, so what will happen to commercial banks if they're no longer needed to hold deposits and to run the payment system anymore? In particular, who will take care of lending and borrowing in the new system? That's question one. And then question two is, where and how will the political debates and the political struggles about the role of CBDC versus bank money take place? Who will be the key players in those debates and struggles?
Well, as to the first question, you know that it relates to the presumed problem of bank financing, but in actual fact, banks don't need that much finance in order to create bank money. They need a certain base of central bank money. They need central bank reserves, settlement reserves, but only a fraction, because the payment processes among banks are much more frequent. Money travels much faster in the interbank circuit than in a public circuit, which allows the banks to operate on a very small basis of central bank reserves, and cash is dwindling anyway. And so banks do not need deposits. Customer deposits in the banks are not, as Michael Kumhof has formulated that they are not loanable funds. So our money in the bank does not represent loanable funds for the banks. Banks don't need that in order to extend credit. So, and that's why the so-called disintermediation problem does not really exist in that sense. No? And yeah, and so creation of bank money will not be interdicted. The central banks say we want to introduce CBDC side by side with bank money, which creates that complicated constellation. So banks can continue to create bank money if the public accepts that or wants to or demands that. And so, yeah, that's the first. And the second is, with the spread of CBDC, banks, of course, can and will have to use that CBDC to pay out money according to the customer demand. As I said, it's comparable to the situation in the 19th century, but where you had much cash and not so much at the time, not so much bank money, and that will, for the foreseeable future, be again the case. You will have a growing share of CBDC, which banks need to finance 100%, but also side by side with that continued bank money creation. So I don't see any problem of so-called intermediation. And of course, sorry, it's about a recomposition of the money supply. It's not about changing banking practices with regard to extending credit, lending, investing, and so on.
Thank you very much.
Yeah.
Our third and final speaker, Michael Kumhoff, Senior Research Advisor at the Research Hub of the Bank of England, previously at Stanford and the IMF. And he'll be presenting his paper, Central Bank Money, Liability, Asset or Equity of the Nation, written together with Jason Allen, Will Bateman, Rosa Lastra, Simon Gleason, and Saula Omarova.
Oh, thank you. Okay. Yeah, that was a really good discussion just now. I enjoyed that. That was especially debunking that nonsense about disintermediation was refreshing. I wish we could have more discussions like that among trained economists, because that was right on the money as far as I was concerned. So this is a joint paper with legal scholars. I'm the only non-legal person on this ticket. Simon Gleason, for example, is a Clifford Chance, major law firm in the city, and more recently a High Court judge. Saula Omarova, you will all have heard of, Cornell Law School. Rosa Lastra is a big name in London, Queen Mary, etc. And the other two are Australian legal scholars. And of course, the usual disclaimer applies. In my case, to the Bank of England, this is just research work. And in fact, this paper did not even appear as a Bank of England working paper. So by way of background, there have recently been, and there may be further, increases in central bank balance sheets. The ones in the past have been due to QE, the ones in the future may be due to CBDC. The assets on the balance sheet are mostly government debt, and the liabilities are various forms of central bank money, CBM. And I will use that acronym from now on. And the question is this increase a sign of strength or vulnerability of the central bank and, by implication, the nation? It would be a sign of vulnerability if we considered this additional central bank money, additional debt, and you will often see people casually sort of saying, oh, this money is a liability of the central bank without thinking further about what they actually mean by that. Or is it a strength And that would be if central bank money is broadly part of central bank equity, although definitely not the same as central bank equity. So the debate has been mostly a narrow and formalistic one, where various analogies with commercial bank balance sheets are employed. Using the concepts of corporate debt and equity, we will use the same concept to frame our debate and see where we are in relation to that. And our argument is that CBM is sui generis and not formally like corporate debt, asset or equity, that it monetizes and utilizes the full sovereign faith and credit of the Commonwealth in the service of the real economy, and that makes it equity-like as a stake in the nation rather than a debt of the nation, although it's a very special kind of equity, which has then critical economic implications. History of central bank money is a different take, but very closely related to what Joseph just said. So we had the gold standard where CBM was the holder's claim on central bank gold, and CBM was a lower level form of money with gold as the highest form. And in that context, it makes sense to think of central bank money as a liability of the central bank because it is a very concrete liability to deliver gold. But we haven't, in some sense, moved on from that, and that's a problem. Is there an analogy between central bank money and commercial bank deposits? Bank deposits are a legally enforceable liability of commercial banks. When I say legally here, this is always backed up by 5 legal scholars. Okay, I'm not talking as an economist and making things up as we economists like to do. So central bank money is not a liability of the central bank to do anything. Okay. And this is even acknowledged by a leading economist, Beuter, in 2003. Central bank is itself the highest form of money. And the key sentence that occurs throughout our paper is that you cannot ask for repayment of central bank money in anything other than central bank money. So the central bank has maybe a liability to give you a fresh note if yours is looking a bit tattered, but that's it. And the same in the context of any future CBDC. Now, central bank money in economics, Ricardo Reis in a paper in 2019 saying reserves are just another form of government liability. There we have that word, liability, okay? What this may miss is that a liability side item, because central bank money is certainly on the liability side of the government's, of the central bank's balance sheet, does not need to be a liability. It can be equity or it can be a hybrid. So some, just something special, sui generis, or so it's on the liability side, but that's it. This has major implications for resource flows because money has a high convenience yield and thereby a low interest rate and thereby a low interest cost for the central bank, by implication the government. And also reserves are not defaultable, whereas debt is. So if you look at the consolidated balance sheet of the government and the central bank, and you look at the reserves part versus the government debt part, the reserves are not defaultable because you cannot default on something where the only thing that something can ask you to do is to issue more of the same, right? So the convenience yield does not apply to interest-paying reserves, which we have a lot of these days, but it does apply to cash. It applies to unremunerated reserves, and it would also apply to retail CBDC because it has a high convenience yield. And if you fix the CBDC rate, then the risk-free rate must be higher by the convenience yield. And if you fix both the CBDC rate and the risk-free rate, and you keep a spread which is equal to the convenience yield. And so what this means is that if, as a central bank, I issue central bank money or CBDC against government debt, purchasing government debt in the market, then I save the interest difference between the two, because one of them can pay a very low interest rate and the other one pays a much higher one. Okay. And so that has fiscal implications, first order fiscal implications. The other one is the default risk premium. Without going too much into the literature, but there's plenty of evidence that higher defaultable debt means higher interest rate, higher real interest rate, not just nominal interest rate. Paper by B, former colleague of mine there, and inflation attenuates but does not invalidate that argument. There is empirical evidence that if you have less defaultable instrument outstanding in the market, you pay a lower interest rate. It's quite clear. And for corporates, that's very universally acknowledged. A more leveraged corporation has to pay higher interest. And the same is true for governments, and not in quite the same way, but it is true. And so if you buy government debt and issue CBDC in return, there is less defaultable government debt outstanding and more non-defaultable CBDC outstanding. And that means ceteris paribus, you should be paying a lower interest rate, even on the debt, not just on the CBDC, but even on the debt that remains outstanding. Very important paper by Archer and Moser-Böhm. This was a BIS paper. This is also still in economics. They emphasize the unique national welfare purposes of central banks and that and the key features of central bank. Let me just jump to the conclusion that they come to is that central bank money acts more like equity capital than debt obligations, because central bank money is perpetual in nature. So that's more or less the conclusion that we're going to get to, but in a more subtle way and in a more legal way. And there's also a paper by Bosone et al., who are scholars in accounting. And they make a very similar argument, but coming from the accounting perspective. Now, let's go to the legal dimension. These concepts, liabilities, assets, equity, they exist because of law. Law defines what that means when I say this is a liability. And they create obligations by the courts. And we will argue that CBM does not correspond to any of those three legal concepts. So, and then we go in the paper, we go through all three of them. I'm only going to go through two. The main one, of course, is liability. The accounting standards is a liability is a present obligation of the entity to transfer an economic resource as a result of past events, and the legal nature of an obligation should determine the accounting treatment. And the essence of the legal liability is that the debtor is obliged to do something which it has not already done. Okay, that's not true for central bank money, because the central bank has already done it. It has issued it, and all it can be asked is to accept an old note for a new one. But that's it. So that's not a liability. Equity, defined as claims on the residual interest in the assets of the entity. Now, in a balance sheet sense, that is true for central bank money. If we deduct assets from what liabilities, and now what are obvious liabilities from the assets of the central bank, we come to the sum of equity and central bank money as formal equity and central bank money. But when it comes to the ownership aspect of this, corporate equity gives you certain ownership rights like dividends, rights in insolvency, procedural rights. They don't apply to in the same way to central bank money. It's a different type of equity, if it is equity, and we'll come to that. So it's not like shareholder equity, because there is statutory shareholder rights for the shareholders in central banks that are different from typical corporate equity. Okay, I will skip over asset because it's sort of obvious that it's not an asset, but we argue why. So we argue that central bank money is financial infrastructure, so access to financial infrastructure and thereby social equity. Holding central bank money permits, in the case of cash, participation in exchange, which is a social activity. In the case of reserves, it allows the participating banks to participate in the clearing system and thereby in the money creation system, which is an economically very valuable right. So we can therefore make social equity analogies with private equity. In terms of control, it's control of the payment system rather than control of a private corporation. The dividend is seigniorage. It was especially for reserves. It's the seigniorage creation or the convenience yield that you obtain via cash and CBDC. This is not a legally established category, but it warrants for further development. And so what we're doing here is we come up with a classification table where we list on the vertical axis various different aspects of a financial instrument, and on the other on the horizontal axis we list what those instruments are. This is what that looks like. And so we're going to have, let me just jump straight to it. On the left, we have corporate equity. On the right, we have corporate debt. That sort of frames the spectrum. And then we have in the middle, central bank money, commercial bank money, and government debt. And we have divided this into various different aspects into the rights of the holder, the nature of the settlement, financial aspects, and some practical issues, especially transferability. And I just want to, now it's just a helicopter view. So I have circled here, there's corporate debt on the right-hand side, and we have central bank money there in the second column. And you see there's virtually nothing in common. Okay, I will go into the details. This is just, I want you to see the big picture. Nothing in common with corporate debt. Then we go and compare it to corporate equity, and there's not a complete overlap, and you also have to say privately versus socially in some cases, but there is quite a bit in common. Then we go to where the differences are, and the differences are mainly due to the very different nature of private equity and this special type of equity, that's money. Corporate equity offers you a financial return versus this social equity or central bank money offers you a social return that can have a financial aspect, but it's broader than that. And that social return depends on it delivering a stable value, whereas corporate equity, obviously, by its very nature, does not have a stable value. And the social return depends on easy use in exchange and very easy transferability, which of course is also different for corporate equity. So that's the big picture, and this is then the final table. And I will now, how much time do I have left? 5 minutes. Yeah, okay. So the rights of the holder. Does the instrument give you control over the issuer is the first category. Corporate equity, yes, it's often delegated, but it gives you control over the corporation. Central bank money does give you control over a key public function, but the control is also very indirect. It is very indirect in a corporation. If I'm just a small shareholder, my control is very diluted, right? It's the same when I'm a cash holder, but I can vote with my wallet by, for example, going to the dollar if my local currency doesn't, if my local central banker is useless. That's voting with my wallet. Or I can vote at the ballot box, because ultimately central banks are still democratically accountable if they were to completely underperform. Does the instrument give a residual or a fixed claim? Corporate equity gives you a private residual claim. Central bank money is a social residual claim. So in that sense, it's also quite similar. Perhaps the most important category is the instrument defaultable. Corporate equity is not defaultable, right? If the corporation goes under, you lose all of it through the valuation in the market of the equity, but you cannot default on equity. Central bank money is not defaultable either, because you cannot ask for repayment of central bank money in something other than central bank money. Now, some people sometimes say, but how about inflation? Inflation is legally something completely different from defaulting. Okay, any legal scholar will tell you that. There may be, just in terms of its value, it might have analogies for an economist, but a legal scholar would tell you that's not the same. It's completely different, right? Nature of settlement. Is there a finite settlement term? And what is the settlement item? So basically, corporate equity doesn't have a finite settlement term, and central bank money doesn't have one either, right? once it's outstanding, you cannot, it does not have a term limit or something like that. I will jump over the other things because time is relatively short, 3 minutes, because I want to say something about what all this implies, okay? In government debt statistics, central bank money is can be accounted for in various different ways. There's two different forms of accounting for government debt. One is general government debt, which is central state and local government, but excluding things like the central bank itself, in which case all the central bank held government bonds would be included in general government debt. And that's, for example, used by the EU under Maastricht and the debt ceiling in the US. Or you could look at public sector debt, which is general government, but also public corporations, including central banks, which is used by many statistical agencies. That includes central bank money because it looks at the liability side, consolidated liability side, and it excludes thereby the bonds held on the asset side of the central bank. And that's used by the UK and also public sector balance sheet statistics of the IMF. And as I said, by many statistical agencies. So now, implication of this accounting treatment for perceived government debt burdens, right? How do I best account for the fact that central bank money is a hybrid instrument? Well, if I use public sector debt and not general government debt, I consolidate the central bank and the government, which is really, you want to look at what's the whole public sector together look like. The implication would be that the consolidated debt burdens would be lower because the central bank money portion of it would now be accounted for as this hybrid instrument or equity-like hybrid instrument and not as debt, whereas the assets, the bonds that the central bank holds would disappear from view. This would lower the debt burdens and that would affect creditworthiness. For some countries, that's a big issue, and for an increasing number of countries, given the way in which debt is growing. There are qualifications. Is the CBM issuance sustainable is a major one, and that's why, if you do temporary quantitative easing, but you expect to reverse it in the future, you cannot really say that, oh, you have a permanent benefit to your creditworthiness because you expect this to be reversed. But if you issue a CBDC and the CBDC demand is high and stable, you expect this to remain outstanding forever, and therefore to have the balance shift between central bank money and debt be permanent, in which case that would be something that where you would now think that the creditworthiness is improved. And then you need to look at macroeconomic circumstances, especially the boogeyman always here is inflation, right? If you issue central bank money, would that not cause inflation? That's again, just like the discussion of central bank balance sheet, it's something where we're stuck in the 19th century or in the 20th, but looking more or less at developing countries. Yeah, and this is basically, if you issue cash, this is true. If you over issue cash, this would give rise to inflation because the general price level is the only price that can adjust to equate demand and supply of public money. But if you issue interest-bearing CBDC, then the price that can and will adjust in order to equate demand and supply is the interest rate that you pay on CBDC. And the price level, there's no necessary first order implications for the price level and thereby for inflation. It is all, you can't ignore inflation. You have to do this in a way, if you are going to do it, that doesn't create inflation, but there's no necessary link here. For retail CBDC, this would be widely demanded, issued against government debt, and the effects on fiscal sustainability would be lower consolidated debt levels and lower interest costs. For the two reasons that I mentioned earlier, CBDC itself is cheap because it has a high convenience yield. And if it's issued against government debt, it lowers the defaultable debt burden of the government and therefore the interest rate that you have to pay even on the debt that remains outstanding. Okay, so the conclusions here, major claims, central bank money is not, legally speaking, a central bank liability. It's obviously not an asset. It's also not like shareholder equity. but it's something that the closest we came, we concluded we could call it is social equity, which has economic implications in the sense of lower public sector debt burdens, if you take this argument seriously, and lower public sector interest burden for sure. And the methodological implications is that, you know, basically lawyers and economists should work together more. We cannot do what we so often do as economists and just make things up, because at the end of the day, when it comes to these financial instruments, what they really mean is ultimately decided by law. And that's why I decided to work with lawyers here in order to get closer to what central bank money is. Thank you.
So we have either long 10 minutes or short 15 minutes time for Q&A. I will have a quick look at what's happening on Zoom. A lot is the answer. And a tunnel to infinity. Okay, but I see no new questions here. So let's go to the room, and as before, just raise your hand. So Isabel first.
Yeah, thank you very much. Very interesting. I'm still grappling a bit with understanding what's at stake here and what you really, so I'm a lawyer, maybe I should say that. So is the argument that legally it's not a liability and it's never been, and economists have talked about it as a liability, but legally it's not been a liability.
Mm-hmm.
It's been a liability. Or is it also legally, has it legally been characterized as a liability? But you say if we look at other legal liabilities, this doesn't make sense because it's actually not a liability, but some legal operation would be needed that it would not count as the public debt.
It's the first. Oh, sorry, you weren't finished.
Okay, so the first is it's never been a liability.
Strictly speaking, according to what we're saying, it was a liability under the gold standard, but not after that.
And why? But you said it's counted as part of the debt, which is then
yes,
wrong.
Yes.
But that also has a legal background, no?
No,
so
that's what statistical agencies do because they do it. Because they do it.
Because they do it, not because they are required by law to do it.
Yeah, because not because this is based on a sound legal argument. Let's put it that way.
Okay, that's difficult for a lawyer.
And you know, but these are statistical agencies, right? And it has been called a liability. And the argument that it isn't, as you saw, is somewhat subtle. And up until more recently, this hasn't mattered very much because the size of central bank balance sheets has been comparatively small because, as Joseph said, you can do, I mean, cash use has been declining and the reserves circulate at very high velocity, so you don't need very many of them in order to take care of the banking system. This has changed with QE, so now we're looking at a major component of what could be called either debt or non-debt, and it would change even more so with CBDC. So now it is an argument that people need to actually pay attention to because it has first order implications. So the fact that it has been somewhat neglected in the past may partly be due to the fact that it wasn't that important.
Okay, but so just to understand it correctly, so if the statistical agencies would understand the law better and qualify it accordingly, then it would also have real economic consequences.
Yeah, would follow the yes. And you know, 5 legal scholars, leading legal scholars, and we are breaking new ground here. It's not like
yeah, in law we usually don't count how many lawyers say.
No, but what I'm saying is we're breaking new ground here. This is not where you could go to the statistical agency and say, oh, this is obvious, do it this way. No, because you know there needs to be a debate about this. And that's what we're trying to start.
So we've got you.
I had one more. May I just?
We only have 8 minutes left, so I think we can take that to the break. So now I have Josef on the list, and then the gentleman at the back, and then I saw a hand moving over here. Yeah, and then Leon.
Yeah, Michael, I agree, of course, very much with you saying that central bank money should no longer be considered as like a commercial liability. So, and I also, of course, agree with you saying that central bank money isn't like shareholder equity. It's by its nature, it's something different. So you say it's social equity or however you call it. But then my question is, what does that mean for the central bank balance sheet? Do you intend to continue with doing that balance sheet as we know, but simply introducing a new category of, say, below owner equity, now the social equity, or don't we need a different type of yeah, isn't that in collision with the international reporting standards, financial reporting standards? If you would do that, or don't we need something different? David Ricardo had such an idea already 200 years ago, when he suggested to split the note creating department of the Bank of England from the operational banking department, but it proved to be irrelevant, so to say. What's your idea about that?
So the idea is, I don't think the central banks need to change their reporting per se, because they call it money. But when it then comes to compiling that into consolidated debt burdens of the consolidated government, including the central bank, then it should be taken into account that this thing, money, is not a debt in the way that government bonds are a debt. That I think is what comes out of it. I don't think the central bank needs to do anything different, but the statistical agencies do.
So then the lady with the scarf, because we're kind of doing a gender balance.
Yes, thank you very much. Connecting to what you just answered, because you asked for the cooperation between the lawyers and the economists, isn't then the effect of your argument rather that you try to make money less into a legal creature, so that you sort of can avoid the question of enforceability and what comes with these legal categories, so that because you want to take it out of the accounting category of debt being something that can be enforced against something else. So you try to make money less into a legal category in a way. Is that right?
No, not really. No, I think we need to be very clear what legally money is, and then I mean the cooperation between economists and lawyers in this particular case leads me to say, look, if we look at this legally, we come to a certain conclusion, and we do need to be more clear rather than less clear about what money is legally. And then taking that away, I, as an economist, can come to those conclusions on the last slides, is that this has first order implications for economics if we take it seriously, if we choose to take that seriously.
Okay.
The gentleman in the white shirt at the back.
Thank you. Well, as a historian, I just was think of the performativity in view of that kind of concept. I was just wondering what kind of changes in the legal definition of your topic will bring, like a kind of changes in policies, because that would really help me to understand your thesis. So in other words, if your idea is accepted, what kind of changes we will see in the future?
Political changes?
Yeah,
Yes.
Well, either political or the other social.
As I work for a central bank, I'd rather not go speculating about politics. It's probably safer not to. I'm sorry.
but just to tease out the accounting point, if the accounting provisions change, the debt to GDP ratios that get reported in major news outlets might look different from how they look.
Might look different. And you might even choose to say, look, if we use this new definition, this is what it would look like. If we include it as then, this is what it looked like, but at least it's out on the table, right?
Yeah, many thanks. I found this really fantastic. It solved some problems I had in my head. So many thanks for the presentation. I have a question. Maybe you don't want to talk about politics, but about monetary policy. Essentially, the way I understand what you said is that the central bank money would consist of two types of liabilities. One would be bank reserves, and the other one would be essentially customer deposits of some kind. And I understand what you said.
Are you, wait a minute, let me make sure I stay on top of what you're saying. Customer deposit, are you talking about CBDC now?
Yeah, something like
that. Okay.
So what I understand is essentially you would have two types of interest rates, which would differ for three.
Cash is zero.
Cash would be zero for the CBDC. It would be essentially lower than for the reserves.
Yes.
And maybe you can talk a little bit about what this means for monetary policy in terms of managing inflation problems.
Yeah, I can. I've written many papers about that as an economist. The most recent one came out only 1 or 2 months ago, and basically gives you a second interest rate instrument. You could also, and this goes back to some of the discussions that people had with Joseph, you could also choose to control the quantity of CBDC, but then the interest rate would have to adjust to equate demand and supply, or you could choose to control the interest rate on CBDC and then let people have as much as they want at that interest rate. You always have that possibility. And in the latest paper, we conclude that on, for highly technical reasons, we evaluate that as economists using a metric called welfare, and we conclude that you should have an interest rate rule on CBDC and not a quantity rule, and that you should let that interest rate respond to credit. So if banks don't extend enough credit, you countervail that by issuing more CBDC and thereby stabilizing the financial sphere and through that the real sphere. So that there are major first order implications for monetary policy that we're only beginning to conceptualize and quantify. And much of my recent work has been precisely about that.
So the time is nearly up. There were a few questions on Zoom. I'll take the first one that was asked on Zoom, which is asking you if you could develop why CBM is not an asset, because the person asking the question says it looks like an asset to the banking sector.
Yeah, but that's not the question. The question is it an asset of the central bank? If it's an asset of the banking sector, then, by definition, it's a liability of the issuer, which is the central bank. The question that we ask is why is it, and that's what it is. It is an asset, right? It is, but somebody's asset doesn't need to be somebody else's liability. It can also be somebody else's equity, right? If I hold shares, that's an asset of mine, but it's not a liability of the share issuer. It's the equity of the share issuer, and that's the real question here.
Okay, and with that, time is up. Thank you very much, and thank you to the other speakers and to the audience.